Listen, I need you to pay attention right now because what happened to silver in the last 48 hours is absolutely insane. And if you own silver ETFs, or you've been thinking about getting in, this could be the most important thing you watch all week. Silver just had its worst day since 1980, a 31% crash that wiped out billions in value. But here's the thing nobody's telling you. This might not be the disaster it looks like. In fact, it could be setting up the biggest opportunity of the decade. Stay with me, because by the end of this video, you're going to understand exactly what just happened and what you need to do about it. On Friday, January 30th, silver had its worst day since March 1980. We're talking a 31% drop in a single session. Let me say that again, 31% in one day. Silver futures crashed from around $113 all the way down to $78. People who bought near the top watched almost a third of their investment vanish in hours. Now, here's where it gets really interesting. This wasn't just some random sell-off. This was triggered by something very specific that happened in Washington, and it's connected to something that most financial news outlets aren't talking about clearly enough. But before we get into that, let me show you just how brutal this crash was. If you bought silver at the peak earlier this month, when everyone was screaming that it was going to $150, you're now sitting on losses that would make your stomach turn. The metal hit $113 per ounce on January 28th. By the end of Friday, it was trading around $83. That's a $30 drop. And if you were leveraged through futures or certain ETFs, your losses were even worse. I've been getting messages from people all weekend asking the same questions. Should I sell now? Is this the end of the bull market? Did I just lose everything? And look, I get it. When you see that kind of price action, panic sets in. But here's the thing. What just happened in the silver market is way more complex than just a simple crash. See, silver had been on an absolute tear. We're talking about a metal that started 2025 at around $28 per ounce and shot up past $113 in just over a year. That's a 300% gain. It was outperforming gold. It was outperforming stocks. It was basically the best performing major asset you could own. And whenever something goes up that fast, you have to ask yourself, is this sustainable? The answer, as we found out Friday, was no, at least not at that pace. But here's what most people don't understand. This crash didn't happen in a vacuum. There were specific mechanisms at play, specific decisions made by people in power, and specific economic forces that all converged at once to create this perfect storm. And understanding these forces is the difference between making a smart decision with your money and potentially making a catastrophic mistake. Let me give you some context. Silver hit an intraday high of $121 earlier in the week. Think about that. This is a metal that most of us remember trading around $15 to $20 just a few years ago. It quadrupled in value and then some. The mainstream media was calling it a bubble. Reddit communities were calling it a revolution. And institutional investors were quietly positioning themselves for what they knew was coming. What they knew was coming was this crash. And they knew it because they understood something that retail investors, people like you and me, often miss. They understood that the paper market for silver and the physical market for silver are two completely different animals. When silver was climbing past $100, something interesting was happening behind the scenes. The Chicago Mercantile Exchange, the CME, where silver futures are traded, started raising margin requirements. Now, if you don't know what that means, don't worry. We're going to break it down in detail. But the short version is this. They made it more expensive to hold leveraged positions in silver. Why would they do that? Well, officially, they say it's to manage risk and ensure market stability. But here's what really happened. As silver prices skyrocketed, the people who were short silver, meaning they were betting that prices would go down, were getting absolutely destroyed. We're talking about major banks and trading houses that had massive short positions. They were facing potential losses in the billions. So the CME stepped in and raised margin requirements, not once, not twice, but multiple times over the course of just a few weeks. Each time they did this, it forced traders who were long silver, meaning they were betting prices would go up, to either put up more cash or close their positions. And when enough people are forced to close positions all at once, what do you think happens to the price? It crashes. Exactly what we saw on Friday. But that was only part of the story. Because on Friday morning, something else happened that sent shockwaves through every financial market on the planet. And that something was a nomination that changed everything. All right, so we just talked about how silver crashed 31% in a single day and how the CME margin hikes were squeezing traders. But that alone doesn't explain the sheer violence of what happened on Friday. To understand that, we need to talk about what happened in Washington. On Friday morning, news broke that the administration had nominated Kevin Warsh to be the next chair of the Federal Reserve. Now, if you're not deep in the financial world, that name might not mean much to you, but to people who trade currencies, bonds, and precious metals for a living, that name sent a very clear message. Kevin Warsh is what you'd call a monetary hawk. What does that mean? It means he's the kind of person who believes in tight monetary policy, higher interest rates, and a strong dollar. He's not the type to just print money and hope for the best. He's the type who thinks inflation is the enemy and needs to be crushed, even if it means some economic pain. And here's why that matters for silver. When you have someone running the central bank who's committed to keeping the dollar strong and potentially raising interest rates, that's terrible news for precious metals. Because precious metals typically do well when people lose faith in paper currency. They do well when interest rates are low and the dollar is weak. But when you have a strong dollar and the prospect of higher rates, that's when gold and silver get hammered. The moment that nomination was announced, the dollar index shot up. And I mean shot up. We're talking about a significant spike that caught a lot of traders off guard. When the dollar strengthens like that, it makes precious metals more expensive for foreign buyers. It also makes them less attractive as an inflation hedge because a strong dollar itself is deflationary. So you had this perfect storm. The CME had already been squeezing leveraged traders with margin hikes, and then suddenly you get this news that suggests the monetary environment is about to become much less friendly for precious metals. That's when the real panic selling started. Here's what you need to understand about markets. Most of the time, prices move based on expectations about the future, not what's happening right now. The actual monetary policy hasn't changed yet. Warsh isn't even in the job yet. But the market doesn't care. The market looks at that nomination and says, okay, this is the direction we're heading, and it prices that in immediately. By the afternoon on Friday, it wasn't just about fundamentals anymore, it was about forced liquidation. See, when you trade futures, you're using leverage. That means you're controlling a much larger position than the amount of money you actually have. So when prices move against you, even by a small amount, you can get what's called a margin call. That's when your broker says, hey, you need to put up more cash or we're closing your position. Now imagine thousands of traders getting margin calls all at the same time. They all have to sell. They don't have a choice. And when everyone is selling and nobody wants to buy, prices go into free fall. That's exactly what happened. We saw silver drop from the mid-90s all the way down to the high 70s in just hours. Trading was halted multiple times because the moves were so extreme. But here's what's fascinating about all of this. While the paper price of silver was crashing, something completely different was happening in the physical market. Dealers were reporting that they couldn't get enough physical silver to meet demand. Premiums on physical coins and bars were actually going up, even as the futures price was collapsing. This tells you something really important. There's a disconnect between what's happening in the paper market and what's happening in the real world. The paper market is driven by leverage, by margin requirements, by forced selling. But the physical market is driven by actual supply and demand. And the actual supply and demand picture for silver hasn't changed just because some traders got squeezed out of their positions. Think about it this way. Do you think the solar industry suddenly needs less silver because of what happened Friday? Do you think electric vehicle manufacturers are going to stop using silver in their components because the futures price crashed? Do you think AI data centers that require massive amounts of silver for their infrastructure are going to say, well, I guess we don't need that anymore? Of course not. The industrial demand for silver is still there. In fact, it's growing. According to the Silver Institute, industrial demand for silver hit a record in 2024, and it's expected to keep growing through 2030. We're talking about sectors like solar energy, which now accounts for nearly 30% of all industrial silver demand. We're talking about electric vehicles that use up to 50 grams of silver per car. We're talking about the massive build-out of AI infrastructure that requires silver in every component. So we have this weird situation where the paper price just got demolished, but the fundamental reasons people were buying silver in the first place haven't gone away. In fact, you could argue they've gotten stronger. This is where it gets really interesting for anyone trying to figure out what to do with their money right now. Let's dive deeper into this margin hike situation, because this is where a lot of people get lost, and it's absolutely critical to understanding what just happened. The Chicago Mercantile Exchange, the CME, is basically the referee of the futures market. They set the rules for how much money you need to have on deposit to hold various positions. And when markets get volatile, they raise those requirements. On the surface, this sounds reasonable, right? You want to make sure people have enough capital to cover their positions so the whole system doesn't collapse. But here's the thing. The timing and the magnitude of these margin hikes can literally make or break a market move. Back in late December, the CME raised silver margins by about 13%. At the time, silver was already on a massive run, trading in the high 70s. Then they did it again on December 30th, this time by 30%. In just a few days, the amount of money you needed to hold a silver futures position increased by nearly 50%. Now, if you're a big institutional player with deep pockets, that might be annoying, but it's not catastrophic. You just wire in more money. But if you're a smaller trader who's already fully leveraged, that margin hike is a death sentence. You either come up with more cash immediately or your position gets liquidated. And when we say liquidated, we mean sold, whether you like it or not, at whatever price the market will give you. Then came Friday. The CME announced another round of margin hikes, this time affecting gold, silver, platinum, and all the precious metals. Silver margins were going up by another 36%. Think about what that means. In the span of just over a month, the capital required to hold a silver position more than doubled. Some people in the industry are calling this the most aggressive series of margin hikes they've seen in decades. And the effect was exactly what you'd expect. Massive forced selling. Here's where it gets really interesting from a strategic standpoint. Who benefits from this kind of price action? Well, it's not the retail investors who bought silver in December thinking it was going to $150. Those people just took massive losses. It's not the small traders who got margin calls and had their positions liquidated. The people who benefit are the ones with enough capital to weather the storm and buy at lower prices. We're talking about the same institutions that have been on the short side of this trade all along. When prices crash like this, they can cover their short positions at much better levels and then potentially even flip to the long side and buy cheap. This is what some people call market manipulation, though the exchanges would never admit it. They would say they're just managing risk. But the practical effect is that retail money gets shaken out and institutional money gets to buy the dip. Now, does this mean the silver rally is over? Not necessarily. In fact, if you look at history, some of the biggest moves in precious metals have come after margin hike-induced corrections. Back in the late 1970s, gold had multiple sharp pullbacks on its way to $800. Each time, people said the rally was over. Each time, they were wrong. The key question is whether the fundamental drivers are still in place. And when we look at silver specifically, those drivers are incredibly strong. Let me give you some numbers that should blow your mind. The solar industry alone is projected to consume somewhere between 10,000 to 14,000 tons of silver per year by 2030. That's potentially 29 to 41% of global supply, just for solar panels. And this is assuming that the technology doesn't get more silver intensive, which it actually is. The newer solar cell designs actually use more silver per panel, not less. Then you've got electric vehicles. A conventional car uses maybe 15 to 28 grams of silver. A hybrid uses up to 34 grams. A full electric vehicle can use up to 50 grams. And EV production is exploding globally. Some analysts are predicting that electric vehicles will overtake conventional vehicles as the primary source of automotive silver demand by 2027. And then there's the AI boom. Every data center, every high-performance processor, every advanced AI chip requires silver. We're talking about massive infrastructure build-outs that are happening right now and will continue for years. The US and China alone are estimated to have consumed over 350 million ounces of silver for data centers in 2025. Put all of this together, and you have a situation where industrial demand is soaring, but supply is basically stagnant. Why is supply stagnant? Because most silver doesn't come from dedicated silver mines. About 72% of silver production is a byproduct of mining other metals like copper, zinc, and lead. So unless there's a massive increase in base metal mining, silver supply can't really expand much. This creates what economists call supply inelasticity. And when demand goes up, supply can't quickly respond. And in a market like that, prices have to do the adjusting. But here's the catch. That adjustment doesn't happen overnight, and it doesn't happen in a straight line. What we're seeing right now might just be the market violently shaking out weak hands before the next leg up. Or it could be the start of a longer correction. The honest truth is, nobody knows for sure. Now, let's talk about why some of the smartest people in the precious metal space are actually getting more bullish after this crash, not less. Because there's a massive structural shift happening in the silver market that most people completely miss. For most of modern history, silver has been primarily a monetary metal and an investment vehicle. Sure, it had industrial uses, but that wasn't the main story. The main story was that silver was gold's little brother, a cheaper way to own precious metals, a hedge against inflation, a store of value. But something changed in the last few years. Industrial demand has exploded to the point where it now represents over 50% of total silver consumption. And it's not slowing down. If anything, it's accelerating. Let me break down what's actually driving this because the numbers are absolutely staggering. First, solar energy. This is the big one. Solar photovoltaic panels use silver because it's the most electrically conductive metal on Earth. Each panel contains somewhere between 15 to 25 grams of silver. Now, that might not sound like much, but when you're talking about billions of solar panels being installed worldwide, it adds up fast. The European Union alone has set a target of 700 gigawatts of solar capacity by 2030. China is building solar infrastructure at a pace that's hard to even comprehend. The US is ramping up domestic solar production. All of this requires massive amounts of silver. Some estimates suggest that solar could consume up to 85 to 90% of today's known silver reserves by 2050 if current growth rates continue. Think about that for a second. We could literally mine every ounce of silver we know about, and the solar industry alone could consume almost all of it by mid-century. That's not even counting all the other uses. Then you've got the electric vehicle revolution. People don't realize how silver intensive these vehicles are. It's not just the battery, though that uses silver too. It's all the electrical connections, the charging systems, the power management components. Every single one of those systems relies on silver's superior conductivity. The automotive industry is forecasting that silver demand from vehicles will triple by 2030. And here's the kicker. As we shift from internal combustion engines to electric, we're not just increasing silver demand per vehicle, we're also increasing the total number of vehicles on the road globally. This is a double whammy for silver demand. But the trend that really has people excited is artificial intelligence and data center infrastructure. This is relatively new, and it's growing faster than anyone predicted just a couple years ago. Every AI chip, every high-performance GPU, every server rack in these massive data centers requires silver. Not gold, not copper, silver. Because when you're dealing with the kind of computing power and data transfer speeds that AI requires, you need the absolute best conductor available. That's silver. The global build-out of AI infrastructure is just getting started. We're talking about trillions of dollars in investment over the next decade, and all of it requires silver. Some analysts are estimating that data centers and AI applications could become one of the top 3 sources of silver demand by 2028. Now, here's where this gets really interesting from an investment standpoint. All of this industrial demand is what we call price inelastic. What does that mean? It means that even if the price of silver doubles or triples, these industries are still going to buy it because they have no choice. There's no substitute for silver in most of these applications. A solar panel manufacturer isn't going to say, well, silver's too expensive, let's just not use it. The panel won't work without it. An EV maker isn't going to redesign their entire electrical system because silver went up in price. The cost of silver is a tiny fraction of the total vehicle cost anyway. This is completely different from investment demand, which is very price elastic. If silver gets too expensive, investors can just decide not to buy it. They can wait, they can buy something else. But industrial users don't have that luxury. What this means is that as these industries grow, they're going to soak up available silver regardless of price. And remember what we said earlier about supply being basically fixed? You've got growing price inelastic demand hitting a wall of fixed supply. Basic economics tells you what happens next. Prices have to go much, much higher. Some of the more bullish analysts are talking about silver potentially hitting $150, $200, or even higher over the next few years. Now, are those targets guaranteed? Of course not. Markets can stay irrational longer than you can stay solvent, as the saying goes, but the fundamental case is there. There's also a geopolitical element to this that we haven't touched on yet. Both the United States and China have officially designated silver as a critical strategic metal. China has implemented export controls on silver starting in January 2026. This is huge. When countries start treating a commodity as strategically important, it fundamentally changes the market dynamics. If China restricts exports, that means less silver available for the rest of the world, which means tighter supply, which means higher prices. And China isn't doing this for no reason. They understand that silver is going to be crucial for their own industrial development, particularly in solar and electronics. So you've got this setup where the physical market fundamentals are incredibly bullish, but the paper market just got absolutely destroyed.